Hello, everybody, and welcome to the latest edition of LPL Market Signals. Jeff Bookbinder here, your host for today, with my friend and colleague, Quincy Crosby. Quincy, how are you today?
Good. How are you, Jeff?
Good, thanks. Hope you and the family had a nice 4th. We focused more on our dog than ourselves because we had a big birthday. Our little doodle Bella turned 3 this weekend, July 3rd. So that was certainly the highlight of the weekend, no doubt. Although I was out last week, spent the week on Cape Cod. How was your holiday?
It was good, thank you. Yeah, we are very big supporters of enjoying the 4th of July and what it stands for.
Amen to that. God bless America. So hope everybody had a nice 4th. Here's what we're going to talk about today. 3 things. First, strong second half rebound prospects for the market, of course. Still in a bear market, but we think the odds of a strong second half are good. Second, though not in conflict with the first bullet point, we are lowering our year-end S&P 500 target. Although in our weekly market commentary today, which you can find on lpl.com, you'll see we are constructive, not complacent. And then last, the big data point last week was the PCE inflation number that the Fed pays attention to. So we'll talk about that as well before we wrap. So first, here's a chart of the S&P 500. 3825 is where we closed before the holiday weekend, but futures are solidly lower this morning. We've titled this slide, Working to Carve Out a Bottom. So Quincy, I'll start with just a question for you. Have we really made any progress carving out a bottom, or are we still waiting for more signals?
I think we're waiting for more signals. We have a tendency because it's, how shall I say, it's comforting to go back in time. How did the other bottoms manifest themselves? How did they present themselves? And now one of the things, Jeff, you hear this constantly. Well, why isn't the VIX climbing over 40 the way it did with previous periods in which there was turmoil in the market, volatility in the market, and the VIX would climb above 40, and then you'd have that selling climax where the last seller gives in, and we create a bottom. How about this? How about we may not have all of the same signals, especially with the VIX, which, by the way, is a product that emanates from the Chicago Board of Options Exchange. It is basically buying downside protection on the S&P 500. I should point out, because there are those traders listening, that I could also buy call options, thinking that the market is going to go up, and I want to protect myself to the upside. But again, it's known as the volatility index, right? Here's the point. This downturn that we're experiencing in the market, this desperation to find that bottom, to find the equilibrium of the valuation on the S&P 500, did not come about because of a major shock to the system. It's not like when we had the Lehman Brothers fiasco, disaster, and every single investment bank going down the tubes. And the market kept looking for that old maid card. Where are those subprime mortgages and the leverage that was associated with those portfolios? That didn't happen this time. And so we kind of know, that's why it's been almost more orderly, I think, than previous periods in which volatility spiked. We know why this is happening. There's inflation. The Fed is determined to curtail that inflationary trajectory. And they have come out and said so many times, look, we're going to do it, whether or not. He's used the recession word. We have to do it. So I think that is what makes it more difficult, Jeff, is that has not happened, that we're looking for something astounding on the downside. However, and I want to point this out, the more the Fed raises rates, and in fact that they raise rates at the next meeting, so far the market does see 75 basis points. What we're seeing is that financial conditions continue to tighten. And this is what's important. If liquidity dries up, liquidity being the oxygen for the market. If we have companies that cannot go to market to raise money, particularly in the high yield area, which is usually our first sign that there's a problem, they can't raise money unless they offer tremendous discounts for buyers. The Fed has made a mistake, a policy error, they broke something. That could be what gives us the bottom. It's a terrible way to look at it, that we have to wait for something like that. But so far, it's been rather orderly.
Yeah, I think it's fair to say we've seen some signs of that capitulation in the crypto space, but
Yes.
It hasn't really leaked over too much into traditional corporate America. So
exactly,
we'll certainly keep watching for that. I think our technical strategist Scott Brown believes we have made some progress in terms of showing some really negative breadth numbers. In other words, a very high percentage of stocks below moving averages, a very high percentage of stocks in bear market territory, things of that nature. So we'll keep watching those as well. But certainly some progress has been made, but not a lot. We know it was an awful first half, but of course, what matters is where we go from here. And so there are a number of ways to look at this, but we have several studies here that show that there's reason to be optimistic about the second half here. One is this table that we showed before. You see how well stocks historically have done after entering a bear market, which of course we did a few weeks back. We're now a little bit out of it, or right around it, 20% down. You see here, after those bear markets start, on average, a year later, you're up 15%. But if you look at medians and take out the awful 1973 and the awful 2008, and certainly we don't think this environment is anything like either of those, then you get a median of 24%. So over the next 12 months, this is certainly a reason for optimism. We can also look at how stocks have done after really bad quarters, right? We just had a really bad quarter, 16% down on the S&P. So if you look at all the quarters that have been down that much or more, historically, we found 8 of them with the help of Bespoke Investment Group. On average, next 3 months, we're up 6%. I don't know if we necessarily would take that. Maybe we want to do better, but 6%, not bad. But look at what you get the next 6 months and next 12 months, right? You get down, after those down quarters, you get up 15% on average and up 26% on average. So this really bad quarter is likely to be followed by gains ahead. You do the same thing with down half years. So after more than 20% down half years, we found 7 of those. You see here on average, S&P 500 up 8.5% the next quarter, up 21% up the next 2 quarters, and then up 31% over the following year, and gains in all of these 6 and 12-month periods. So this is just math. This is what history tells us. After these really bad periods, stocks tend to rebound. So here, my question for you, Quincy, is it too optimistic to expect this kind of a rebound over the next 6 to 12 months?
Well, let me just, if I may, give some data, historical statistics that over the last 20 years, again, from Bespoke Investment Group, over the 2 weeks following the end of June 29th, and 2 weeks hence, the median for the S&P 500 is over 2%, about 2.1%. So, when you go over the past 20 years, one thing that stays the same is that we're in the waiting period for the official opening of the earnings season. Is it too optimistic? No. I mean, one other part of the optimism is what happens after the midterm elections. The first 3 months after midterm elections, the market has statistically a very strong bounce. And over the course of the year, that bounce tends to hold, eases out, but gives us an average return of just over 16%. So you also have the midterm election statistic of the bounce. But overall, what we're waiting for is that the Fed finishes up the aggressive campaign to curtail inflation. The minute, and the market's going to see it, you were going to talk about it later, but the market is going to see it. When the Fed feels as if inflation has plateaued viably, I say viably so that they know that that's the trajectory, it's entrenched rather than entrenched going up, it's moving in the right direction. Because what we believe is it could happen this year. And what then would be the case for the market is that the market discounts the end of the Fed's aggressive campaign, perhaps brings us to a pause, perhaps actually gives us maybe 25 basis points. Or if there's this also this, how shall I say, this option in the market, and that the Fed feels as if, well, you know what, we're doing too much damage to the economy and we need to just pause. And I'm not saying that's the best scenario, but nonetheless, the market would probably rally on that news. But as long as the market feels that inflation is being beaten, the Fed uses the right words, plateau, peak, moving in the right direction, and that the data underscores that, and that the Fed's rhetoric either becomes more dovish or certainly less hawkish. That would be something that would move the market. And that could happen as we get into the end of this quarter and early fourth quarter.
Yeah, that's such an important point. You look back at these historical lows, these major lows, you see Fed pivots driving the inflection point, and that's certainly what we're waiting for. And that means we have to wait for inflation, which we'll talk more about in a minute, which is, of course, the key to the Fed slowing down. Growth matters too. You know, if we enter recession, growth gets too weak, the Fed could blink. But certainly we've got to watch the inflation side really closely. Inflation's tied to our decision to lower our S&P 500 fair value target for year end, because inflation is certainly tied to interest rates. Inflation and interest rates are tied to stock valuations. And so our earnings forecasts haven't changed, but we think PE multiples have to come down from our prior expectation. And that's what you see here. This new target of 4,300 to 4,400 is based on a PE of 1819. That is a typical late cycle PE valuation. Certainly in 2000 we had much higher, but in other more recent market cycles, we tend to see bear markets peter out, or bull markets rather peter out, sort of in that high teens range. So we think we can get there. Hopefully we get there by year end. But this is really not an earnings call. I think our earnings forecasts are very realistic right now. They are well below consensus. We're just saying that PE has to come down. And you can see here, this is a table we put in the weekly market commentary for this week, where you can see the valuations and the earnings and where they come together, right? So consensus is still $250 a share for 2023. That's almost certainly going to come down during earnings season. Our forecast is 235, and it's been there for quite some time. So we're already factoring in some downside, of course, from slower economic growth, but also margin pressures from the inflation problem. But where stocks can do better, we think, over the coming months is with a re-rating of the PE ratios from 15 to 16 now to up to 18, 19. So Quincy, you think that 18 to 19 range is fair? What has to happen for us to get there?
What has to happen is that, the challenges embedded in the global supply chain ease, even at the margin. And, you've got China beginning to open. If they begin to have their, factories open again, which is, obviously part of their mandate as they open the economy from the really grueling zero COVID policies where everything was closed down, particularly Shanghai for 2 months. You could start to see the global supply chain easing, the challenges easing, shipments coming back in on a fairly regular schedule. We're seeing prices regarding freight shipments, trucking shipments, and shipping from Shanghai over to the west. Those prices are coming down, indicating that it's beginning to function on a more normal scale. The reason I mention all of this is, the Fed is only dealing with demand, but if we can have supply ease and meet demand, the Fed's job is going to be made more. What's the word I want to say? Possible that they can reduce prices. That's the goal, is get prices to come down across the board. And so I think it'll be reflected in the market. And again, it's not if, but when. So can we get there? We need China coming on board. They're beginning to. It's beginning to open. We hope that there's not another COVID scare where they close things down, because they're very, very quick to close things down. And as I said, we're starting to see across the board prices beginning to ease. That will help. And at the same time, you're beginning to see here in the US, in terms of the ISM numbers, the Institute for Supply Management, Purchasing Manager numbers, they're weakening. And I know this sounds it is contrarian, but when they really pull back, to the point that they cross over the 50 mark, because 50 constitutes expansion, albeit slower expansion. If they go below that, both in the manufacturing, and this week we'll hear from the service sector. By the way, that tends to help build that bottom. I just want to mention that, and that tends to be where the bottom comes in, and we move from there. And statistically, it has a very good, what shall I say, backdrop in terms of statistics and telling us when the bottom is coming in, because those numbers scare the daylights out of the market, because they tend to have a very good positive correlation with growth, positive correlation with S&P 500 forward activity. So again, this is where the bad news becomes the good news. And then also, speaking of bad news becoming good news, we're taking a look at the labor market. Obviously, what the Fed wants to dampen is the potential for a serious wage price spiral. And that is where you have many workers, but many, many more jobs. And the workers can come in and say, hey, I demand more. You want me to work there? I'll do it, but you're going to pay me more. So what we're looking for is not for the labor market, which is healthy, it's still solid, to deteriorate in a meaningful way, but to have the number of jobs come down. Because when the number of job openings diminish, then you clearly have a situation in which the worker has less, what shall I say, less backing and to demand higher wages. And it sounds terrible when you talk about it, but you're looking at it now from the market's perspective. So that's where bad news becomes good news for the market. So all of these are possible as the Fed continues its course of aggressive tightening. Now the question will be, Jeff, when we get to the meeting for the Fed, which is at the end of this month, if the economic data deteriorate in a more meaningful way, do we see the Fed back off of the 75 basis point hike and move more towards 50? That's going to be interesting, because for the market, what it'll signal is that the Fed is blinking, right? They set the stage. They've had a litany, a parade of Fed speakers up until now coming out and saying, hey, we embrace 75 basis points. Well, if they move back to 50, it will tell you that they're blinking. If the inflation numbers do not recede accordingly, or that there's no confluence of that. So how do I say this? The market is poised to accept the slowdown, but what it wants to see is that inflation numbers pull back, and more importantly, it wants to hear the guidance from companies having a more optimistic view. I don't know, Jeff, if you're following this, you always do. Jeff. Yeah, you want that slide to go away. Yes, you want that price to come down. Of course you do. Of course you do. And alas, how do I put this? China on board. China gets most of its oil from Russia. But if those sanctions really hit, and then China has to take more oil from the same sources where we get our oil, who knows where prices are going to go? That's one of the arguments that the energy sector has, is that it's still tight, supplies are still tight, and they will tighten even more when China comes on board. You know, during the their COVID shutdown, maybe they were using 1 million barrels of oil a day, if that. But opening, it is going to move towards where they usually go, and it's a multiple of 1 million barrels of oil a day. So this is the big dilemma: get those prices down, and get them down quickly. That could change the market's tone, because this competes with the Fed's raising rates. Together, they tighten the economy more than just the Fed tightening by itself.
Yeah,
Don't make that go away. Make that.
I'm going to try. Well, I mean, the only good news I can say about this is that oil prices have come down about 10% off of their peak, so we will get a little bit of relief. I'm also happy to report that I still have not paid $100 to fill up my tank yet. If I let it go down to nothing and run on fumes, I might break that $100 mark. But for now, I have not as of yet. But, you know, it just keeps coming up, Quincy, over and over again. Inflation, 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 right? Which connects to the Fed, connects to interest rates. We got this PCE number. This is, again, what the Fed pays most attention to. And it was, you know, I would argue pretty good, right? Yeah. I mean, this number's come down for a few months now.
Yeah.
And is in the fours, right? Not, you know, 8.6% where the CPI was headline, but yet the markets didn't really seem to care. I mean, even within this number, you know, there were some positives, right? I mean, auto prices continue to come down. Fourth consecutive month of slowing auto price inflation. In fact, used cars rose at the slowest pace since May of 2020. Supply bottlenecks certainly are improving. You mentioned that, Quincy. Car market is beginning to normalize after all of these COVID disruptions. Jeffrey Roach points out that high gas prices are slowing demand for RVs. Certainly the reopening is probably a little less RV friendly as well. So, you know, these are all positive developments. They're taking down the Fed's most important inflation indicator. However, you know, at the same time, the Fed is worried about travel-related inflation, right? You know, within the PCE, we've got, you know, worrisome housing inflation, right? Rents, worrisome restaurant inflation, hotels, and other hospitality prices certainly are up quite a bit and haven't really shown any signs of slowing as the reopening, you know, continues to work its way through. So, you know, there's a lot, there are countervailing forces here, Quincy. I guess the question I would ask here is, why didn't the market like this PCE more? Is it just, you know, is it a head fake and really all that matters is prices at the pump and prices at the grocery store, which of course are not in core PCE? What is it, do you think?
First of all, I think the market expected that. And one of the reasons, Jeff, is that the prices, just use travel, for example, use airline tickets. They've been fairly consistently lower via the PCE report rather than when the CPI comes out. So that's an issue. Healthcare services, it's usually, how do I say this, less inflation-like in this report than it is in the CPI report. Mm-hmm. So I think that the market has become all consumed now with the Fed's course. And unless this changes and the CPI changes dramatically, this is going to have to show a deeper retrenchment of inflation. I think that's what it is. Remember when the Fed actually was moving towards 75 basis points, and they pointed to the consumer sentiment report, and it was the preliminary report where inflation expectations from the consumer moved from 3.1% to 3.3%. Do you remember that?
Mm-hmm.
And that, along with the CPI, was enough to have the Fed go and break all tradition after being signaling 50 basis points. And we don't have to go under. And Chairman Powell actually mentioned it. He said that made us move. That Friday morning made us move before the Fed meeting that next week to go to 75 basis points. Then when the final report came out, the University of Michigan Consumer Sentiment Report came out, the market took a major sigh of relief and moved up that morning. The market had turned positive, but it got a huge boost if you looked at following the markets when that announcement came out, because the 5 to 10 year expectations for inflation on the part of the consumer back from 3.3% to 3.1%. So that's the kind of data release that gets the markets into attention. At some point, this is going to be important again, as the CPI is going to be important again. But the market does the shift, and I think right now, what the market is most focused on is earnings. We're moving into that period where the earnings reports and the guidance are extremely important for the trajectory of the market over the next month, at least, I think. And right now, it's not, the earnings are still solid. Yes, they've come down, but according to FactSet, we're still expecting companies to do better than they did, during other periods in which the Fed was raising rates. But it is pulling back. We've seen negative revisions. We've seen some positive revisions too. But I think the market, again, this tug of war, is expecting, companies to come out and say things look awful, they're horrible. And yet it doesn't appear that way based on the earnings reports that we've been receiving so far. You've been reporting those. The FedEx report, for example. There are a host of companies that have been saying, yeah, we understand that conditions are slowing, but we're doing well. And that's why the market, I think, is waiting to hear, are there many other companies in that camp that are saying, we're navigating. We're navigating our operating margins. Yes, they've pulled back inch lower, but we're still making money. Top line revenue growth is still solid to strong. That's what the market is waiting for now. The market goes through its sort of, what shall I say, litany of anxieties. And so those anxieties, the top of the list change. And right now it is about earnings. And again, it's about oil prices. High oil prices alone can cause a recession. Where we are fortunate now is that vehicles, except mine, are much more, what's the word I want to say? They don't burn as much fuel as they did back in the 70s, right? So that's a help. And also the other aspect to it is that for the middle to high wage earner, it's not as much a detriment to their cushion of cash, their ability to pay. It's not fun, it's not great, but they can do it. Where it hurts are the lower wage earners who perhaps travel more to where they work. And the Fed has a study that suggests that 71% of the lower wage earners' income goes towards necessities, which you would have to say at the pump, that's part of it. Whereas for the middle to high wage earner, only 31 to 35% of earnings goes towards necessities, which is food, which is rent, and travel. So that's the scenario that we're in. And as I said, if the sanctions on Russia deepen, you may see oil prices move higher. And there too, if the market believes that a recession is at hand, you'll see oil prices come down along with the rest of commodity prices, which have been climbing lower and lower as the market prices in a significant economic downturn.
Yeah.
Did I answer the question, or did I just go off on a on the deep
No,
end.
well, what you did is you I think hit on all of the things we want to watch this week, right? So here's my list. Jobs report on Friday, right? We want the job market to cool down from a market perspective because there are so many job openings, and you mentioned it earlier, Quincy, the tight labor markets are putting more upward pressure on wages than the Fed wants. So probably shouldn't root for a booming jobs report, but we probably won't get a booming jobs report. Consensus is around 250. We did 390 last month, so something around that number I think would be fine. On the Fed, these Fed minutes are a little bit stale, of course, because they come out a few weeks after the meeting. But with all the market's attention on the Fed, any little hint that the Fed might slow down or end this rate hiking campaign sooner than the market thinks could drive a rally. And then lastly, and this is one you probably just spent the most time on, Quincy, it's corporate America. And it's been really impressive how resilient corporate America has been during this inflationary period with supply chain disruptions. I mean, we continue to get examples of how tough it is, right? GM can't finish a bunch of cars right now, right? And so that's going to cause them to miss their numbers just a bit. Micron, the chip maker, is another one. The tech equipment orders are, of course, going to slow, PCs and the like. And so it makes sense for a company like that to see less demand now than they saw during the pandemic, which was frankly a perfect storm of demand for companies like that, as we all outfitted our home offices and we all stayed at home on our PCs and mobile devices. So, you're going to continue to get these, but the estimates have only come down, about 0.5% from the peak. That's not much at all. We think they got to come down more. And this earnings season will start that process. But frankly, it's so consensus right now that estimates need to come down.
Right.
That if they don't come down a lot, then the market could rally on that. So just keep in mind how negative the expectations are, not the published estimates, but the expectations anecdotally from analysts and strategists, especially the top-down strategists out there that are coming up with numbers well below 250 like we are. So this really starts the earnings confession period. We had a little bit last week, but this really starts it, and that'll be, I think, a big focus for investors this week. So anything else, Quincy, people should be watching? We covered a lot of ground, but anything we missed?
Yeah, you talked about the macro view of estimates. What about the bottom up? Take a look at the analysts. These are the sell side analysts on Apple, on Amazon. There's the buy. I mean, it's so strong.
Alphabet, I think, has 52 buy ratings from 52 analysts. That's not meant to be a recommendation on Alphabet, but how is that helpful?
I rest my case. Either they are the most prescient group of mankind, or the majority of them are wrong. And that's why we have to hear from the companies themselves, because most of them are not going to change their ratings until they hear from the companies. Usually they'll wait, just like with the pre-announcements. They'll wait to hear, a confession from a company, and then they feel like they've got the cover to go in and do a negative revision, right? It's the way it works. They don't want to go in before the company speaks. But that's what's going on. And I think that's the reason, Jeff, that so many folks are looking at the market and saying, I want to go in. Why shouldn't I just go in now? Because look what these analysts are saying. And I'm not talking about the macro analysts. That tends to be more esoteric. But those buy ratings get strewn all over business television in the headlines. And then, you'll have folks sitting there saying, well, why aren't I going in and buying more? Because look at what they're saying. This is a disconnect somewhere. And that's why, how do I say it? That's why I think sometimes you look at this and say, are we really going to be going into a deep recession if companies themselves are giving us positive guidance, or at least solid guidance? Are we going to look at what they say and then claim that they're not correct, that they are the ones who hear from their own customers, their own clients. They are the ones that see ahead. And that's why the guidance this time around is particularly important. And why the market is waiting in bated breath to give us the term, and as you say, an inflection point that is different from the inflection point we're waiting for from the Fed.
Yeah, the combination of corporate America being in great shape,
yeah,
and then consumers having at an aggregate level, a lot of excess cash, money markets and whatnot, checkable deposits, still trillions of extra cash beyond what they had pre-pandemic, puts us in a great shape to manage through a modest recession if we have one. And that's probably the base case. If we have a recession, probably going to be
shallow. Yeah, you've got $1.9 trillion for corporations, not counting financials. And you have some states, I won't name them, who, writing out checks for folks. Now, does that feed inflation? Yeah, because you're looking at the opposite from the market perspective. But you'll have folks able to, to have more cash to spend and just keep going through this, this period of much slower growth, and then much slower growth.
Yep, absolutely. Well said, Quincy. So I think I'll end with this, previewing our mid-year outlook for 2022, which will be out next week. In fact, the podcast for next week will feature the mid-year outlook presentation. So looking forward to that. I won't be able to make that podcast. So I'm not sure who we're going to bring for you. Ryan has moved on to pursue another opportunity. We wish him well. So going forward, you're going to hear from me. You're going to hear from Quincy. You're going to hear from Scott Brown, our technical strategist, Jeffrey Roach, our economist, and others. We're going to mix it up, I think, going forward. So we'll bring some of those people next week to walk you through our mid-year outlook 2022. We're really excited about it. Great job again from our designers who just do an amazing job, not just of bringing us great images like the one you're seeing now, but in sort of tying the theme together and effectively telling a story. So that'll be cool. I guess, Quincy, the first LPL Outlook you have contributed to. So excited about that too. So thank you, Quincy, for jumping on here as my co-pilot to play on the mid-year outlook theme there. And thank you to all of our listeners for joining us. Really appreciate you being here and continuing to make LPL Market Signals a success. So with that, everybody have a great day, and we'll talk to you next time.